This is episode 231 of Zen and the Art of Real Estate Investing with my guest, Randy Smith. Randy is the founder of Impact Equity, and he brings over 25 years of experience in corporate sales and leadership to real estate investing. He launched Impact Equity in June 2022. They help investors place money across several different projects with world-class operators. Randy also launched Raise Capital Coaching and Consulting to help new capital raisers start their business. Also, he's the co-host of The Gentle Art of Crushing It. Randy, welcome to the show.
Yeah, thanks so much for having me here. I'm excited to be here.
Yeah, no, I always like to talk to investors who've come from a different world and use those skills to do well in investing. But I think it's really interesting that your dad was really involved in real estate. Is that where you got the bug for real estate and you just thought about it later?
Yeah, I ultimately, yes, that's where the seed was planted. I do have a little bit of the rich dad, poor dad kind of background where dad was a cop in LA. And he ended up buying apartments and did very, very well financially.
Yeah.
And then mom and stepdad bought a small business in Northern Michigan. And very different story. So,
Yeah.
yeah.
But did you go on site to the buildings when your dad was buying them, or wasn't you were too young or not interested?
You know, my mom and stepdad had moved us across the country.
Oh, okay.
By the time my dad started investing in those, so I just got to hear the stories. Yeah.
Yeah, but that's good though. It puts it on the radar. So you lived in the more poor dad part, and then you were watching the rich dad, right?
Something like that.
Yeah.
Yes.
Yeah. Just generally from the story, not of course in that. So when did you decide that whatever you were doing wasn't enough and you wanted to turn real estate into something that would be more of a full-time thing for you?
Yeah. So I was early 40s. When it really finally got a hold of me. I always believed that you needed to have a lot of wealth, or you needed to have a ton of capital sitting on the sidelines before you can get involved. And you and I both know that that's not the case.
Yeah.
But that is one of those limiting beliefs that kept me on the sidelines for a lot of years.
Choosing Turnkey as a first investment is smart. It's generally passive if you get a whole system coming along with it. And I feel like I've been saying a lot now, I think there's a lot of people who right now, because of what it costs to buy houses, they're going to probably just dunk into turnkeys instead and still rent because it's better, a better option to rent. So it's kind of like these strategies that you use to get started really could come back and help people now as well, because it's just harder to buy a regular single family home if that's what people are looking for.
Yeah. And I think there are some very large scale professional turnkey providers. I know a handful here in Arizona and some on the East Coast that are really good options. They provide pretty decent cash on cash, and they're in appreciating markets. So over time, it's going to appreciate in value. So
yeah, that's really the long-term mentality. When you look at turnkey, you have to think like, hey, let me grab a market that's also going to appreciate. So this 200 a month will steadily go up, but also my out value is going up all the time. So I have equity if I want to repurpose it along the way.
Yeah. And I think that strategy works. I went the other route where I invested with a not so reputable company. I found out after the fact. My due diligence was terrible. And I was buying assets that were, old, tired, what you would expect in like a BRRRR or a flip situation.
Yeah.
But he wasn't doing the quality of renovations that would need to be done to make this thing cash flow for years and years. So you buy a turnkey or out of pocket 25 or 30 grand, and then you get an $8,000 bill for a roof in 6 months. Like that kills your cash flow for the next 6 years.
Yeah. Well, do you think that you were short on the due diligence just because you were so excited to take action, which is, is still a learning lesson?
Yeah, no doubt. There were all kinds of mistakes that I made. I'm a first investments. And, like the biggest one that really kind of comes to mind is you always hear if you're buying a house, get an inspection. And, he came to me and said, hey, we already do inspections and you're more than welcome to get your own inspection, but here's mine that you can use as well. And I'm like, gosh, he's such a nice guy. He's already done the inspection. Why would I waste the $300 or $500 on an inspection? Well, I can tell you exactly why you should do your own inspections.
Yeah, absolutely. I mean, that's just a good tip for everybody who's just someone who wants to make it easy. It's always worth spending that little amount of money, even if it turns out that you find something big and the deal fails. That's good. That's a learning lesson there.
Absolutely.
Because if you would have found that 8K roof, you're probably still hopped up. You're going to close the deal, but maybe you get a 4K credit. So it's a little bit more, palatable later. I don't think you want to buy into somebody who's saying, oh, well, 5 of these 7 aren't going well, but it was just, it was a bad buy. Well, I mean, the whole reason why we trust you with our money is to make a good buy. So we all make money,
Exactly.
don't buy
Exactly.
with floating rate debt, and those are the things that honestly most people don't know. And again, like we were saying, you're really excited when you decide, hey, syndication seemed like a great option, that it is easy to just hop on board because there's a lot of tremendous marketing out there, as you said, but that doesn't mean that it has the systems that you need. I too look at how many deals they've closed, how many have gone full cycle. And then for me, particular now, especially because of the rates, I'm just looking at what debt they're carrying. It's so important to me because everyone who's in trouble is generally because it's floating rate or bridge or something like that, or some type of alternative,
Yep.
1 year thing. That's the entire problem. Most of the ones that were bought with fixed rate debt are able to go through no matter what. It's, maybe they made a bad call if they're doing value add, but I'm not
Yeah.
investing in value add right now.
Well, and it's interesting. Like I agree with you 100% wholeheartedly. Debt is the single biggest risk factor
Yeah,
in
yeah,
any deal that you do. But there were a lot of people doing 5 and 7 year debt 5 and 7 years ago.
yeah,
Uh, so if you're having to refinance today,
yeah.
hopefully, if
Great
you did
point.
buy 5 or 7 years ago, that you've got enough equity in there, and it's not going to be as good of a return as it could have been. But you still, everybody took a haircut in the last 2 years.
Yeah.
So that's important to look at too.
You got into syndications pretty quickly. If someone's out there now and they have good income, disposable money to spend, but they don't want to spend it on a single family house or they own a single family house, what would you recommend based on your experience going through all of it and, talking about the market now today? What would you
Mhm.
tell someone? Because I think what I would recommend is changing every year. It's really, it's different each time as we look at rates and opportunity and inventory.
Yeah, so I think there are certainly market cycles, and there are better opportunities, better times to get into the market. I think for folks that are coming into the space now, it's a really good time to do exactly what they're doing. If they're listening to podcasts, they're
Yeah.
starting the education journey, and then I generally just say, like, try to get on the phone with as many operators as you possibly can. Start dedicating time to education. Like I have on my website that 110-point due diligence checklist process.
Oh,
I
awesome.
share that with anybody, right? So go out there and find all the free giveaways that everybody has, and you
Yeah.
can start your education journey there. Um, and then at some point, you got to pull the trigger and put some dollars into play because all the studying and research in the world is not going to ever teach you as much as going down to the bank and wiring a few dollars and seeing what an investor update looks like and getting a distribution
Yeah.
and dealing with K1s and all of that other stuff. Uh, but I would urge folks too, like, don't don't set the goal to go out and deploy a ton of capital in a short amount of time. Like if you've got $200,000 or $300,000, maybe put 50 grand in a couple of deals this year. And then next year, maybe 50 or 100 grand in a couple of deals. Because you don't have to have a ton of money at play for this to have a pretty big impact over time.
Yeah, if you're patient. That's fantastic advice though, because I think I've always found that the push, at least, social media and marketing wise, is taking action means buying or investing, but it's not. What you said exactly is get educated, listen to podcasts, build relationships. That's taking action to me, because if you take action the right way, podcasts, meetups, relationships, books, put those all together, you're going to have much more confidence than if you're just watching YouTube all day and, thinking that everybody's telling you the truth. It's really but you have to know that you are taking action when you do that, or else you will get stuck in that analysis paralysis state, because you're just like, oh, I'll just vet, 50 syndications. You're never going to
Yeah.
choose if you're looking
Yeah.
at 50 and you don't even know what you're doing yet. You're just looking at,
Yeah.
all these documents with 10, 30-year projections that I skip those parts.
Right, right, right. Yeah. And I think just as important is get around other people that are doing what you want to
Yeah,
do.
for
So
sure.
if you want to be a passive investor, go find passive investors. And you might not find those at the local RIA because those
Right.
are generally active investors. So there's a lot of online communities, there's a lot of conferences. And just listening to podcasts, you're going to hear there's tons of podcasts that are just focused on passive investors.